So this then brings us to the four financial statements. Okay? The four financial statements that we use in accounting, and of course we also use in finance. Now, what's often considered the first of these statements, although they really aren't in any particular order, is the balance sheet. Okay? The balance sheet, as I mentioned, is assets equals liabilities plus equity. The balance sheet. Now, the balance sheet is a snapshot of a company at any given moment in time. So right now, you could go to any company anywhere on earth, assuming they have their books up to date, and just print up a balance sheet, right? Or bring it up on the computer screen, and it tells you where that company is at that particular moment. Now, if it's a global company and constantly doing business, the very next moment it's already changed, okay? But that's where that business was at that moment. So balance sheets usually say, as of year ending December 31st, 2014, right? So they'll say as of a specific date. That's where the balance sheet is. And so of course, quarterly statements that are published, it's at the end of every quarter, we're going to see the balance sheet of that business. And the balance sheet is the personification, as it were, and the manifestation of accounting, okay? Well, if the balance sheet shows us the accounting equation, then no sheet out there better shows us the financial equation than the income statement, okay? The income statement, different than the balance sheet in a couple of ways, well, in every way, really, but primarily the balance sheet, remember it's a snapshot? The income statement takes place over a period of time, and that period of time depends on you. What do you want? You can run an income statement from the very first transaction that was ever conducted in the business. It's not often you do that, but you can do it. More often, what we do is we do income statements for quarters and income statement for a year. So for the year ending, so what was the income generated by that business that year? What were all the revenues minus all the expenses generating the income? Okay, so we do that quarterly. What's the income for the quarter? What's the income for the year? We specify the duration, the time frame that we're going to look at. And then during that time frame, the income statement, it lists all of the different sources of revenues, all of the different sources of costs, and subtracts the costs from the revenues, arrives at an income. How much money did we make? Now, these are really the two principal financial statements. Okay, balance sheet, income statement. Now we've got another one, my personal favorite, the cash flow statement. Cash flow statement tracks our cash. The actual, as it says, the cash flow statement, the flows of cash. You see, because as we're going to learn a little bit later, the reporting of income, okay, when income is generated, when costs are incurred, things like that, don't necessarily match the flow of cash. I could just take my own business for an example. I have a retail business, and so I sell things to the public. As such, I have to charge a tax or a VAT, right? Now, I have to pay that tax to my local government on a quarterly basis. So every 3 months, I have to send a decent-sized check over to the state of California and send them all of the all of the sales tax that I have collected during that period. So the sales tax that I collect is not income. It doesn't belong to me. I collect it, but it belongs to the state. I collect it nonetheless, and it goes into my accounts nonetheless. On my cash flow statement, we're going to see this. We're going to see the cash coming in. You're going to see it accrue for 3 months. And then every 3 months, I pretty much empty that account out, and it goes off to the state, pay off what I owe the state. We see that in the cash flow statement. We're not going to see that in the income statement, right? Because tax is not an income to me. It doesn't go anywhere on my income statement. The tax that I pay is a cost on my income statement, so you'll see that down below, but you'll never see on my income statement the inflow of cash, of tax into my business, okay? So another thing that we often do in business is we depreciate things that we buy. So if I buy a truck for my business and I expect to use that truck for 5 years, I'm going to depreciate that truck over 5 years. And I'm going to speak about this a little bit more when we talk about the rules and the guidelines of accounting. But just as the basic example, I have to pay for that truck either up front if I buy it all cash, or I pay for it during the time that I financed it for, and you're going to see the outflow of cash as I pay for it. And maybe I finance it, so I finance it for 3 years, but I put, maybe the truck is $30,000. I put $10,000 in cash down. The cash goes out. And then I pay for that truck over 3 years. So over 3 years, the cash goes out. But on my income statement, I'm equally going to divide the cost of that truck over 5 years. So you're not going to see that big $10,000 deposit, that outlay of cash. You're not going to see that on the income statement. You are going to see it in the statement of cash flows. So, although income is a driver of cash, the income statement and the cash flow statement can differ, and sometimes significantly. This is the reason we have the cash flow statement. One is to show us the income our business is doing, that's the income statement, the income that we're getting or the loss that we're getting. The other one is showing us the cash that we have and the cash that we have on hand. And that's very important because I need that cash for certain things. I've got to pay creditors, I've got to pay salaries, I've got to make sure I have the cash. When salaries are due, my employees don't care that I was profitable last month. Where's the cash? Where's their paycheck? Okay, that's what they're interested in. The final financial statement actually goes by many different names. It's kind of funny. I call it shareholders' equity. It can be called the statement of retained earnings. It's got a lot of different names out there depending on where you go. But basically, this is the statement that shows us the nature of the equity that we have in the company. So assets equal liabilities plus equity. So what is that equity? And what form is that equity in? And what were the changes in that equity? The equity is the ownership of the company. So if it's a publicly traded company, how many shares were bought or sold or issued? How much money has been paid into the company? How much of the ownership has been taken out of the company? In a typically traded company on the stock market, the payment of dividends is the returning of equity to the owners. Right? So the company has generated an ownership value of a certain amount and they want to pay that back to the owners or pay a portion back to the owners. So that's going to come out of the equity of the company. So the statement of retained earnings or the statement of shareholders' equity basically shows us the nature, the amount and the nature of the equity. So is it owned by one person, by many people? Is it common stock, preferred stock, et cetera, the different kinds of ownership that can occur within a company. It shows us that, and it shows us how it's changing from period to period. So those are the four financial statements. The balance sheet, the income statement, the cash flow statement, and the statement of shareholders' equity or the statement of retained earnings. And these are the statements that we use in analyzing, valuating companies, and doing our accounting. Accounting is the department that puts those statements together, and then finance often uses those statements to evaluate the business, to see how the business is doing, to run the different ratios, and investors use those statements to make their investment decisions.